ladies and gentlemen. Welcome to today's webinar. I'm Joseph Novichkov, Senior Trading Manager with GDM. First of all, I would like to apologize to you guys. I'm feeling a little bit down today. It's probably some kind of flu going on around, so my voice could be a little bit shaky. But that doesn't stop us from our main goal, and that is to finish our month of webinars with today's last day of the webinars. It's the last day of the webinars, ladies and gentlemen, for a very simple reason. 29th, this Friday, is actually Good Friday. You know, we're getting into the Easter holidays here in Bulgaria, so today have to be a little bit longer period of webinars, because we are actually going to talk about a few types of range trading systems. It was actually supposed to be 2 parts, because there are quite a few that have piled up, but I had to cut around only for the Good Friday, because we won't be working at the office at that time. Therefore, I've selected just about a few. However, furthermore down the road, I might be able to sneak in a few more range trading systems, or I can possibly reveal most of them to you guys on a one-on-one session in any convenient for you time. Of course, you know how to do that. Go to our website, GDMfx.com. Over there you will have a pop-up chart. You can request a call back from a senior executive or from me directly. So we can schedule a meeting if, of course, you are a trader within our midst. So basically, what I'm trying to say is that for those that are here, usually, which are not yet our traders, we could offer something as a stimulus. We might be able to throw on some special bonus or an agreement or a type of trading account which is specialized for you only, for those that are attending the webinars. But since we have a lot to talk about today, I will just skip the usual chit-chat about the firm, what we can offer you. But most of all, I can tell you that whatever you're interested in, we can help you to achieve it. Mostly, we can be able to establish a trading plan for you by asking you just a few simple questions. It's very easy, really, to find out what type of trader a person is, and of course to recommend suitable systems that you can add into your already existing trading plan or develop a new one along with you. So, first of all, when we talk, ladies and gentlemen, about ranging markets, what we need to find out first, before we actually start trading this market, we need to find that range. Basically, we need to identify it. How to identify it? There is just a few simple ways of identifying a range-bound market on the Forex market, or in any other market, regardless whether it's commodity market as the gold, which we're looking at the moment. I picked the gold chart to talk about ranging markets today, because what we have is the most recent ranging market which is currently going on. This is gold. It's a very large range, to be honest. You can see this is on a 4-hour chart. The range here, the normal range, is about $39, so you can imagine that's a pretty good range. There are a lot of false breakouts, as you can see. We will talk about that as well. But first things first, what we need to do is identifying that particular range. To define it, we need to know what are the conditions under a range forms. So a range, ladies and gentlemen, can occur when the price has bounced off the same support area at least twice and the same resistance area at least twice. Now, these are the simple rules that we need to remember. So this, of course, will create 2 high points and 2 low points, which of course the two high points or two low points don't need to be stops and reverses at the exact same level, which means that a lot of the cases, the price continues, rallies to a new high or drops to a new low, but of course manages to pull back within the range, only to create support and resistance zones. Now those zones, ladies and gentlemen, are very, very important when we're talking about ranging markets. Let's pull out the chart a little bit so we can have a better overview. For those that have smaller screens, it might be very difficult for you to grasp the right side of the market. It depends, because I have a very large screen in front of me and I don't know. You might be using a 15.4 inch screen, or even smaller if you're looking at through your tablet or smartphone at the moment. It is very important, ladies and gentlemen, when we talk about ranges, to locate the first two low points and the first two high points. So when we see that the price pulls back down here, we have our first low point. Now basically the rally up was so severe in this case here that the pullback was 100%, driving the price to the same area over here, which makes it a very, very key support level. The next thing is to identify the second high, because we already have the first high, which is this one. The second one comes over here, and the final one is over here. Now what we see, everything above these levels, ladies and gentlemen, are our support and resistance zones. Now we already know that when we have to define this particular range, we have to go firstly to the support area, which is over here, and I'm only taking the closings of these two candlesticks here. I'm not interested in those swings. And of course the same we're doing with this one, and I'm always taking the first high and the first low. Why we're doing that? It's very simple. You will find out during the session what I'm talking about, and this is a typical range. Now when we talk about a typical range, the two low points are of course not necessarily to be connected, or to be honest, you don't have to pick the lowest point here, or you can have it as a tighter range, for example, and of course leave the first swing low here as your reference point, making it the support area. Now when we talk about support areas, we have to take under account every following swing low. At the moment we don't have one here, but we can take a look on the above on the resistance zone here. We see that there are a lot of other prices which are acting as a resistance. Now this, ladies and gentlemen, is the common range-bound market. When we talk about the range-bound markets, we need to identify those support and resistance zones. Now when we see the support and resistance zones, we're always taking the first swing high here and the first swing low here under account. Everything above this zone is a false breakout, which we will also talk about in the following minutes. And as we can see, there are a lot of closings above this resistance zone, which of course, talking about a resistance zone, this area here is our resistance zone. Why I'm painting it this way, it's for you, because I have to use a rectangle to define it much better, but it's more difficult to move it up and down. Therefore, just the area between this and this line is our resistance zone. Everything above that is a false breakout. The sharper the move down, the sharper would be the move up. And of course, the more aggressive the moves are, the more false breakouts we will see. Also, when we talk about support and resistance zones, we also have to take our extremum here, which is down here, and this here is made to be our support zone. Everything within those two lines is the support zone. This is what we're interested in, because everything below there and again above here will be acting as our stop losses in the future. Now we'll take another look at a different case later. Let's say a more perfect type of a sideways direction or a ranging market. But first of all, we need to see what we can expect in the live trading, what we can expect right now. So when we are taking a long or a short position, our stops always have to be above the final resistance zone and below the final support zone as well. Because every price hike below this level or above this level here will be taking the particular instrument that you're trading into a new high, possibly establishing a new trend or continuing the old one. But as we know, what is the rule for trending markets? The rule is that a trend is more likely to continue instead of reverse. But of course, moving forwards to our particular system, this is only the beginning of how you're actually starting to trade. Identifying your particular range from where you're going to be buying and selling. Of course, identifying the support and the resistance zones, which are by far the most important piece of the puzzle here, before adding your tools like those that we will be talking about in a few minutes. And of course, having in mind the nature of the instrument that you've been trading. Now, in our previous webinars, ladies and gentlemen, we've been talking about every single major currency pair or a commodity. We've been separating them as individual currencies, we've been talking about their economies, what is standing behind the movement of this particular currency, and of course, the most important, the volatility, and how volatile the particular currency pair or a commodity that you're trading is. Because the more volatile the nature of the particular instrument that you're trading, the more false breakouts you will be getting of this on that account. Therefore, you might need to use a different particular take profit and stop loss management, like for example 2-to-1 reward risk ratio would be very much appropriate for the more volatile units. Now, if you are using, for example, something that has been ranging for a very long time, and you know that it's not that volatile in nature, you might be taking high risk as well. But with very, very volatile units, you should be very cautious because it brings a lot of risk, of course, a lot of reward. However, 2-to-1 reward risk ratio would be appropriate. So with every take profit that you achieve, you would be, of course, covering the losses of the previous position or any of your future mistakes. Because what we do on the market is speculate, and there is nothing that is 100% certain. Therefore, your risk have to be always measured correctly. How to do that? We can, of course, establish a one-on-one session, as you already know how, and of course achieve this by moving forward in the market, and of course by a conversation that you will be left with, of course, the opportunity to learn something more in addition. Now, let's talk a little bit more about the ranging markets, and so we can establish some kind of a connection before we start placing our indicators so I can show you what would be the appropriate type of levels, so on and so forth. The most important thing here, ladies and gentlemen, to find out about the ranging markets is that price ranges occur in all markets. There are no markets that are always trending. Of course, not all of these are ranging for a long period of time. Some of them are ranging for a short period of time. Some of them are ranging for weeks, months, and years. Now, a very typical example, for example, for a sustained trend, uptrend, downtrend, or a sideways trend, or also called the ranging market, this would be stocks. Now, stocks, shares, also indices, those are typical trending markets, basically. If you take a look, for example, here, let's switch to monthly chart. You can see for how long period of time the gold price have been ranging, trending up. Now, from down here, from the price of $287 up to about close to $2,000 an ounce. Now, let's get back within a range. This is, of course, not a typical situation for gold. For example, it's very volatile. It picks a direction. It could be a downtrend next week. It could be at the end of the year, it could still keep going up, for example, or end up in a sideways direction. So the importance here is that you have to understand the unit that you're trading. What would be the nature? This is the first thing. Is it typically ranging? So you can actually pick it as a normal ranging market and you can trade it with confidence. Is it typically trending, this particular market that you're trading? So thereon, you will know what kind of strategy to use. All of this, ladies and gentlemen, is very important and essential to your goal, to your final destination, of course. Now, let's have a look at a very simple range-bound trading system. Of course, it also comes with a good profit potential. Most of the traders that I know rely on the simplest trading strategy that you can actually find. The one indicator that they're using is the stochastic oscillator. Now, the stochastic oscillator, the typical entries, the typical values, they would use 533. Now, when they're using this particular indicator this way, let's zoom in a little bit. We can start seeing better what would be our possible entries. I'm usually shrinking in the chart like this so I can see all my levels, to see all my price swings. Now, as you can see, the stochastic oscillator is a volatility measurement instrument. It is also good to pinpoint possible long and short entries and, of course, trade with larger confidence. Now, it is very important here to understand that when you're trading with the stochastic, rules that are used have to apply always. And of course, you should not compromise with none of this. Now, the first rule here, of course, as everyone knows, we have to see the stochastic crossing over, for example, in this case, crossing over above or below the 80 level, crossing over over each other, and of course starts declining. This is typically the case for a short position. However, you cannot take this opportunity, for example, here. It is very simply put because your price entry that you're entering is at the half of your range, and basically this will give you zero opportunity or a very small opportunity for profit. So what you can typically do is just wait for this moment to be exhausted. You will see how quickly the volatility will drop down here and go to an extremum from where it will go back down again, rewarding you with a success. And your entry points should be at or close, for example, at the resistance area. Now, that is why we started from defining the range, so we can know precisely where the price will have difficulty of continuing. This would be our entry level. And of course, along with that, we need for our stochastic to point oversold condition and quickly enter the market, and of course, taking the profits out. Usually, the exits, in this case, for example, people do rely on the middle of the levels here between this one and this one as a more conservative side, for example. So when you short here, you can take your profit somewhere down or along this line. Now, as you can see, it's the same thing applies when you're taking long positions from as low as, for example, over here. We have our price well below that middle level here, so we know that when we see a case like this one, oversold conditions, our stochastic is crossing over up, we can always buy here, close here, or partially close and leave the other one for the other case. Now, the interesting fact here when we're trading the range, ladies and gentlemen, especially with something as simple as this, is to avoid being greedy. It is very commonly seen people to lose money on the market, on the ranging market. So the possibilities that you have on the ranging markets are numerous, based on the fact that the price is swinging between two lines, gives you the opportunity to quickly make profits. But of course, if you do not define this particular range well enough, or stay within a trade thinking to yourself that this could be just a false breakout, and at the end the market starts trending and you're bucking that particular trend, you will end up losing money eventually. So when you're trading a range, few rules here are good to remember. Do not leave too long any position open. Take your profits as quickly as possible to the middle level of the range, or at least partially, and leave the rest for the other opportunity which is above or below the range. But most of all, do not rely on a range for too long, because as we can see right now, gold is ranging for quite some time. But let's take a look at a different case. It's a very interesting case, by the way. I'm just going to swing by over here. Okay, this is visible much better. You can see the trend ending down over here, two swing lows, two swing highs, making you that particular range from here to here, $30. That's nice. However, you can see how quickly that range is broken, a new trend appears, and that's in a matter of days. In a matter of days, you can lose that range, end up in a trend, wiping out your account. Of course, the price might get back there. It could happen this year, it could happen in 10 years. So pretty much we don't really have so much time to waste or money to waste, because both of those things, time and money, are precious. And what we are doing right now is making money, conserving time. So that is why I'm giving you that particular example, as to for you to remember that do not stay too long in a range, because you will end up losing your time eventually. So this is pretty much the most simple way of considering to enter into the markets. Of course, there is another way, also a very nice range trading system. Typically works with most of the ranges, and most of all, it can tell us whether there could be more exhaustion to that particular downside here and more exhaustion to the upside as well. So we can catch those particular moves, and most of all, it will allow us to stay on the safe side better. It's very important to understand that the range that we have defined might not, those particular levels, the horizontal lines, as you can see up here on 1246 and the support level of 1202, they might not be reached again, meaning that firstly we have defined it here. From that point on, we have no idea what would happen. Therefore, we have to rely on something better to tell us whether we can buy here and sell here, for example, that is way within the range and way past those horizontal lines, which we've defined that range. Now, when the price breaks below, way beyond the established range, only to move back into the range, or moves up away from the upper range, only to get back within, as we mentioned, those are false breakouts, and those are these cases here. Not very much, but there are those which we could say, okay, the market is trending, so I'm going to buy. Yes, but then a few price swings, a few days later, for example, you will witness the case of a very sharp drop, ending up the whole case with losing time and money. And it's the same case here, but it was a very strong. It is a very strong resistance area, as a very strong resistance zone. When we talk about resistance in ranging markets, we don't really have only one zone, because those price swings above and below that are defining our support zone and our resistance zone is the most important part of our range trading systems. So the range trader, and his goal is to enter short position near that resistance zone. So the more you get into that resistance zone point up here, the more aggressive the move will be down, until of course it's actually broken out. And the actual breakout happens in a very large volume. Or with other words, I can show you here, this is a very small range, rather $8, $9, something like that. And what I mean by breaking that range, you can see that powerful bullish candle here, and the next one, and the next one. Now this is an actual breakout. But what we see here is a hesitation of a strong bullish candlestick, but the next one is a very large bearish, making it back within that particular resistance zone, which is a very important area for us. So trading ranges, ladies and gentlemen, are also called rectangles or channels, but please don't confuse the channel trading, which is actually in trending markets. Now let me show you what I mean. This is also a range trading, but it's channel up and channel down. It's very easy to identify it here. Let's see, this is the equidistant channel that we have. This is the upper side, like this, and like this. Now this is a channel trading. This is a channel down. Small channel down here as well. Small channel down here as well. Small channel down here as well. And this is a very sharp channel down as well. So you can see those cases are also range trading, but then the trader usually in a down direction of this channel usually sells when price reaches the upper level, takes profit here, and sells again here until a large volume candle breaks off that range. But what happens when the range breaks, we will talk a little bit further down the road. We have more time, a lot to talk about. It's very important for you to understand that when the range is broken, the price usually gets back within that range for a very short period of time, only to break it again and then establish that particular trend. But let's talk about it later. So now we will talk about range trading indicators, and those that refer to time and entries on the timing of into that range trades. The most commonly that are used among traders, of course, these would be oscillators like stochastic, the commodity channel index, the relative strength index, also the Williams percentage range. Now this is also something that you can use. I'm not going to present it today because we've talked about it a very long time ago. We have it as a webinar. Of course, it's not a particular tool that I would be using in today's market. So that's why those systems that you're seeing today are mostly suitable for the cases of today's market. And what I mean by today's market, let's say this quarter or this year, this is what we have found out. And the particular setup, let's go back here in this case, and of course, obviously remove that stochastic. No, we're actually going to leave it because I might have to add it again in a few minutes, so I'm just going to leave it. The first thing we need to understand here is that the setup for this stochastic is different in this case. We will be using the 1433 particular indicator. It's very important to notice how it's changing. You see, it's extending a little bit more in a period of time. It doesn't matter the time zone, for example, that's the timing of the charts that you're looking at. It's pretty much universal. At this case, you can use it on all time zones. So those indicators are used to form a range trading system which numerous oscillators cannot pick between false breakouts, actual breakouts, so on and so forth. But the commodity channel index, for example, which is not only used on commodities, let's see, let's put it into our charts, and it stands for CCI. So for your information, if you're wondering what exactly I'm talking about, the commodity channel index, the abbreviation is CCI, on your charts usually comes on the drop-down menu on custom. Usually the input here for the commodity channel index, we're using a period of 20. It's a little bit better. Now you will see why. Okay. Since we already have these two and we need them a little bit wider here, so we can see those levels, which are very important for us, and what we can track up here is pretty much where exactly our chart is standing and where the price is, obviously. So for the commodity channel index, the most of the time the indicator is, you can customize it, of course. You can see that all levels are changeable depending on your preferences, like extreme overbought conditions. If you wish to use the default settings, I would use default settings as well. Minus 100 to 100 as levels. In order to get trading signals, of course, out of this, we must consider the price and the commodity channel index. What does that mean? Okay, we can see that the commodity channel index has been undervalued over here, and this is a perfect case where we can expect the price to break through that minus 100 level. We can see that it aligns again with the stochastic. Let me just put this one here. Sorry, it didn't happen. I had to just put it along together with this one. There we go. This is our entry point. You can see the stochastic breaks through, the stochastic crossover over here. Okay, that's long ago. So if we wait for it to break this level, it will be way off. We're missing opportunities, and when we talk about ranging markets, our opportunities are pretty much defined between our support and resistance zone. I think something happened to the screen, so let me share it one more time. Now you would be able to see that again, I suppose, like this. If there is a technical issue, ladies and gentlemen, just let me know if you're not seeing anything. I'll just fix it straight away. But I believe right now is perfect. We can keep going. Now, the commodity channel index, why we're using it is to see whether our price is close to our support zone. As we can see, yes, it is. In this case, it's close to our support area. Speaking of which, we can see that the commodity channel index is breaking up the 100 level, and as a confirmation, only as a confirmation, we're using that stochastic oscillator because it's much slower than the commodity channel index, and it's going to tell us a little bit too late when to enter. So basically, we're entering here on the opening of this one, and we're closing it on a profit of $7, or if you want, you can just wait up for the middle of this particular section. I would take the price from here, close 2/3 of my positions over here, this is about $14 in direction, and leave the rest one to go up there. Now, what I mean by that is simply because gold is very volatile. Therefore, we know that the price hikes within that resistance zone are much more likely instead of staying below this particular zone here, or as they're probably, in this case, a more conservative type of traders. They're looking for a secure profit without taking unnecessary risks, so you might not want to wait until it gets well up above here, close to the final resistance zone here, and you might want to take your profits once the stochastic hits overbought areas over here. And as you can see, the commodity channel index later on tells us that it's going overvalued a little bit. Therefore, we're waiting for another case like this one to break down here for our profits, for our new opportunities. Now, you see, this case of range trading is not the most perfect range, but the thing is, ladies and gentlemen, that life is not ideal. So what we can do is just adjust ourselves as we head along. So the particular systems that we're talking about, that we keep developing for you, are of course noted along with the market conditions in our days, because we cannot really use the so-called stocks trading strategies on paper trading like for example 100 years ago, because the market conditions are not the same. For example, there are a lot of trading strategies that are actually taking something from back then, delivering it today, but it's already changed, you see, because of the volatility of the market, because the number of market participants are so many every day, and the opportunities that we have from electronic trading, that we can actually trade on the go from our mobile device, for example, or even call someone to open a position for us, depending on the way you like to trade. There are numerous of ways. Therefore, the number of market participants are making it even more difficult to find a reliable system to trade. That is why we keep developing systems for you each and every day. We're testing them for about 6 months, then we're making webinars. So you see, it's the world that we live in that is making the necessity of developing new things. So one more time, when the price is within or near the resistance zone, for example, over here, let's take this example, it's within the resistance zone, Okay, we see that it's a strong bullish candle, but this is not our entry signal. Our entry signal comes over here when we see that the commodity channel index has broken. It's actually over here, to be honest with you. Then we have another swing high, but that's not something that we're worried about. Very simply put, we already have our stop loss way up here. Why is that? Because we're always taking under consideration other false breakouts, and we're placing our stop losses way above them, especially on volatile units like gold. So our entry comes somewhere around, let me measure it, there it is. This is the commodity channel index, where it breaks the 100 level to the downside, forming a sharp angle like this one. It could be a double top as well, or a triple top that you can see here. That will only tell you that the move that it's going to be expected down will be gradual, and it will be very, very long. But if you see something like this, very extreme highs, the move down could be very sharp. You might even be you might even lose that particular opportunity because on a smaller time frames you will witness that the moves are very severe, very quick, and they end up very quickly. So that's why I've preferred the 4-hour chart to show you this particular webinar today, because we can very easily navigate back and forth without switching through the time zones, only for you to witness one and the same thing. Back to our question here, our entry signal comes here when the commodity channel index breaks down the 100 level. We see that our price is near or at this case, at our resistance, upper resistance level. And of course, we're shorting down from here. Our stop loss, as we already mentioned, is set up far away from the previous swing highs and false breakouts as well, just to avoid something like this before our profits are taken down here, which is a very good profit. We can see that particular swing high brings back the commodity channel index up above the 100 level, which is not a problem. I will tell you why, because we can see that it's a big volatility, that it's overvalued, so therefore we're waiting for our opportunity to close our trades. This could either happen on the commodity channel index here or on the touch base with the oversold conditions on the stochastic. We can see the crossover above the 80 level, bringing it down on the stochastic, delivering close to the conditions of ideal, for example. So early indications that there might be a down move. Trading signal comes over here, our entry, and of course our exit one more time could happen on this particular moment or on this particular moment, which in this case is pretty much on one and the same place. So if we just measure and see, yeah, you can see it's pretty much on one and the same level. So you can either wait for this level, which I also told you at the beginning that in a lot of cases it will not be reached. Therefore, much better if you rely on the indicators to entry and exit rather than the price to touch a certain level. That's why we have these support and resistance zones, so we know pretty much in which borders the price could swing above our range or below our range, which is pretty much the most important. Now, let's sum up a little bit about this particular conditions of trading. Before I give a few other suggestions of counter trend trading, which is the so-called range reversals. It's a very good idea for those that are consider themselves quite riskier traders than others. It could prove very profitable, and I will tell you why a little bit later. So speaking of which, a range that lasts for a long time, as we can see this one, for example, here, is an example with the gold price, can produce multiple winning trades before it eventually gives way to a breakout and the development of a new directional trend. Certain markets, however, as we mentioned earlier, they can range for a very long time, even years sometimes. So having a range trading system such as this one, for example, can pay off pretty well, especially if you have a favorite instrument, let's say the euro dollar, the pound versus the dollar, if you wish, the JPY versus the dollar. It's been arranged in a range for so long time as well. Last year, speaking of which, before it actually shot up the USD JPY on the development about the rate hike early in December. Not all ranges, of course, ladies and gentlemen, are worth trading. So while a range can be well defined, it could be, of course, very tight, a very small range. So it's not a very good range like this one, for example. Here we have a range of about $40, give or take a few dollars. So now this is a range that you can actually rely on, because on every trade you make here, for example, you will see that you're gaining more than $10 in a position, giving the conditions that we're giving the examples on the 4-hour chart, gold as a volatility, the indicators that we're using. So this is a perfect example of a good trend, good range, which you can profit from. But there are ranges like this one here. Let's take a look at it. Now this range is very, very small. You can see it's about $5, $6, $7, something like this. Now this is not worth trading for sure, because the tighter the range, the likelihood of a breakout as soon as it does is much larger than a larger range like this one. You can see for how long it goes and on the sidelines. Now trends, of course, are what the thing that a non-range trader chases. So basically it also depends on what type of trader you are. Do you prefer to trade ranges? Do you prefer to trade trends? You might be better with trends and not so good with ranges, because the systems that you use are more let's say more suitable for trends, and it's much easier for you. You understand it better. So you see, the conditions under you can trade the range or not trade it at all are a lot. But the basic range traders are usually only trying to capture the approximate size of this particular range. So theoretically, profits in their potential are capped at the width of the range. Ultimately, when it comes down to the individual trader and how they implement their range of range or trend trading systems, some will do better on ranges, other will do better on trends. So trends, of course, as we've been talking about before, their potential is unknown. So you have no idea when the range is actually the trend will end. So as you can see, let's take a look at this case, for example. You know, the range was broken over here, so the trend begins. It ends over here with $140 this distance, and then the retracement was about $40, which actually defined our range, which we're in at this moment. Now, the necessities that a single trader have to do is to actually battle within his own self to understand, or let's say to lose a few trades, let's say in a range, to understand that ranges are too risky for him. He doesn't understand it, so he better do with trends. Other words, for example, people that like to profit quickly in and out, for example, they prefer to trade ranges, and they come very easy at them. For a very simple reason. simply because you're bound between boundaries like upper range level, lower range level, defining your support and resistance zones. You know, some traders find it much easier because they've got some kind of boundaries. But when it comes to range, they're stuck in a range and it's reversals. So some traders might do worse with trends, but better with ranges. The bottom line is, ladies and gentlemen, that trading the ranges that occur when the price of some kind of instrument that you're trading and moving between horizontal support and resistance levels, the profits that you make on this particular system, you always have to enter when the price is breaking down the 100 level on the CCI and breaking the minus 100 to the upside, again, on the commodity channel index. And of course, confirm always with the stochastic, only confirm whether it's in the same direction. Now, these are absolutely the rules for the range trading system today. Of course, let's talk about a little bit about the so-called range reversals, which of course are powerful Forex trading tool systems. The so-called system capitalizes on markets' tendency to revert back toward their main value in time. So when we spoke about gold price hiking from about $300 to about $2,000, and the reversal with another $1,000, I also mentioned that the price gets back to its original point eventually. So this relies, of course, on a simple rule, and there is plenty of room for adjusting to it to fit any conditions in any trading plan. The range reversal signals rely on input from earlier openings on the market. Now, which of course can provide such setups for successful type of range reversal traders later on during the trading day. So everything starts at the beginning of the trading session. The one thing this particular idea implements is that the average daily range on the previous day is going to be the boundaries of today's market, for example. If yesterday, let's take a look at this chart, but before that, we will just clean it up a little bit. Just going to remove everything that we've done so far. I hope you've managed to, to take notes. Even if you have not, this is the time when I will mention that every single webinar is recorded. Therefore, nothing to worry about. You can review it one more time after we upload it. That's probably going to happen as early as next week. Now, speaking of which, we have to take a deeper look. Now, the boundaries of yesterday were here and here, looking at a daily chart. Here and here. Now, these are the boundaries of today. So, when we already defined what the particular range is and what today's market focus from a technical standpoint, obviously, it will be, many traders have to note the tendency for major pairs or commodities to reach their intra-session maximums during the US session. Therefore, the session is a pivotal point for the prices of a range which have to be achieved in the other session. Now, we saw what happens here. This is pretty much how the market closed yesterday. We need to take, let's say, a deeper look. Let me measure that particular range. That's about $13 of range. Therefore, I believe that the 30-minute chart would be suitable for this particular example. As we see, okay, let's first mark the beginning of the day because it's also important. Now this will happen with a horizontal line. This is yesterday. Now when we switch through the 30-minute chart, we will know where it begins today. And this is over here. We know that this is our range now. This is what the market will be focusing today. And our setup like this, for example, focusing on this particular range which has been developed yesterday, will be the market's focus today. And the price, ladies and gentlemen, will be attempting to break either way. Very rarely you will find the price moving within that range, causing the day to end up in a smaller in body particular candlestick. Let me show you here. Like this doji, for example. You see? This is another session, but the range here was very large. So in occasions, you will have this. But most of the time, you will have a large candlestick. The price will attempt to break either way, as you can see, eventually rewarding us with profits. Now in this case, your rules here apply pretty much the same way as the trading system we spoke about earlier with the commodity channel index and the stochastic, pretty much giving you the same idea and the flexibility, but still on a smaller time frame, bound within yesterday's range. So once you start seeing breakouts like this, even this is a false one, until a real one occurs, like on a large volume as we spoke earlier, you see this is a good breakout. This is not a breakout, and you can see that from that particular ugly candlestick here, which says nothing. But this, finishing strongly, even stronger move up with, of course, we're looking at a 30-minute chart, so this is about $2.50 candlestick size. However, telling us that this particular range is no more. We can abandon our range trading system and start trading the reversal, which is actually our point of talking today. So until this point here, ladies and gentlemen, you've been trading that range with the same system we spoke about earlier. Now, we saw that breakout. Now we start trading heavily on a smaller time frame, like let's say 15-minute chart would be also suitable. It would be nice if we actually zoom out a little bit this particular chart so we can see better what is going on here on the 15-minute chart. Now the idea of this counter trend trading, because it's already developed, you can see the numerous candlesticks moving higher and higher, is that every time the price makes a new high, you're selling. Every time it makes a new high, you're selling. Every time it makes a new high, you're selling. But the idea here is quick in, quick out. Heavy lot, quick profits. But the warning here, this is not for a faint at heart. Please remember, this is a very risky strategy. Of course, the rewards are enormous because you know the rules of this particular system, and this means that every time the price makes a new high, the retracement is at least half of the previous session. Therefore, you know how much your profits you're taking. This is about $1.7. Now, imagine you're trading with one lot. This is $17. But if you're actually aiming to make $17 with one lot and you're risking so much, this is pointless for you. The ability here for a trader is to make every time the price makes a new high here, to sell and make $170. The next candlestick he's making another $170 or $150 or even $100. So 10 trades by $100 gives you the profit potential from the whole range trading system, which is about $13, and it's going to give you as close as this let's say your profits are mixed every time. One time is 120, one time is 90. The average potential on 10 trades is the same profit that you might be getting from the particular range trading system. However, the risk is much more different, simply because you're using a heavy lot to scalp those profits. You can see in real time how the price is retracing as we speak. So every time price makes a new high, you're selling. Every time it makes a new high, you're selling. And you know that the maximum profit potential that you can squeeze out is by far the extremum. I wouldn't really risk that much, but I would go half of the real body of the previous session. Now this is $1, but every dollar with 10 lots gives you $100 on one trade. 10 trades are pretty much the ultimate maximum that this system can achieve without your brain overheating, because the essence is that you're actually trading into the US session, which starts in about 30 minutes. So every time the price makes a new high, we'll attempt to get back within that range which was from yesterday. This is only an idea. I'm not giving you any additional info. It's not a necessity that you can use it. It's very risky. So right here, if you start losing money, like let's say you catch that move here, okay? You didn't catch it, but you took this one when the price closed. Then you've shorted, but the price moved up here. Now that's about 40 cents or something. Now that's not even worth staying within it, because that's only the spread that you might be concealing. The spreads are by far tighter, but you get my meaning. Sometimes the spread is not worth the risk of such a position. But the idea of this particular range reversal opportunities is that many experienced traders which are using this are actually making the so-called expert advisors, which considerably minimizes the risk which you might sustain on a greedy profit, which a lot of traders might say, okay, the price is attempting a new high, but then it's going to reverse, but then the rules are that it's going to attempt to get within that range, but those are only rules, and we know that there is nothing that is 100% certainty, especially on today's markets. So giving you the idea of such a risky strategy, you also have to ask yourself whether you're up for the task, and if you have a hefty amount of money to sustain a few larger losses. But when I'm using this particular system to make quick profits, let's say I need something to achieve, I need such an amount of money that I need to conceal within my account, let's say, so I can guarantee myself a bigger position, let's say in a later stage, because I'm expecting tonight, for example, Federal Reserve's interest rate decision. So I don't have enough money into my account, and there isn't much time for me to make that. So I have about $10,000, let's say. I can afford myself to trade with 10 lots per position. Well, until tonight, that amount could come up to 15,000. Now then I can open 5 lots in a directional trend after we find out what the Fed would say. So you can leave this throughout the night with a different strategy, concealing a beautiful profit only because now you have a better solid ground to open a larger position tonight. Because with 10,000, I wouldn't risk trading the trend after the Federal Reserve decision throughout the night and go sleep peacefully with 5 lots if I only have 10,000, because it's very easy. I might get wiped out until I wake up. So I need to have my proper risk-reward strategy set up. Otherwise, I would have to open with only, let's say, 3 lots. But you see, you get the picture. That's pretty much for today, ladies and gentlemen. Please apologize. I apologize one more time for taking so much time from you to explain those particular strategies, but believe me, I wouldn't do it any other way. That was pretty much half of what I have to say for today, based on the fact that there were another 3 strategies for range trading that we had to talk about, but time is of the essence. So expect new webinars next month of May. We're getting very close to the summer season, so we have to have something in addition. We will be talking about binary options. There are a few requests from our traders that would like to see some binary option strategies. So get ready. We're going to talk about binaries, and that's all for next month. Thank you for joining us today. It was a pleasure for me. See you next month. Thank you. Bye-bye.